Ever noticed how parents treat stock market like casino? In most Indian families, talk of shares or stock market is often met with stern looks or panic warnings. Our parents and grandparents grew up believing in the holy trinity of safe investments: fixed deposits, meaning FDs, gold, and property. The idea of putting money in the share bazaar has long been viewed as taboo, a gamble where paisa doob jayega. In fact, even today, the average Indian household keeps only about 5 to 6% of its assets in equities, while over 50% in property and 15% in gold, with hefty portions in bank. This tells you one thing, that most Indian families still favor traditional safe assets over stock market. So why this is almost superstitious to talk about stocks? It's often a silence passed down through generations. Many of us grew in families where adults hardly ever discussed investing in stocks, unless it was to say stay away. That unspoken fear and mistrust of the market itself became our inheritance. Our parents weren't trying to hold us back. They were genuinely seeing market as an unsafe casino. The result? A generation of young Indians who find themselves very difficult to talk about investing, or worse, avoiding it altogether. Let's understand the roots of this fear. But first, I'm Shimal, and if you're new here, I break down AI, marketing, and business psychology from a Gen Z lens. Subscribe for more content like this, and follow me on Insta for daily updates. Now let's get back to the video. To understand this fear, we have to dive into the roots, the generational trauma and mistrust that took hold decades ago. The 1992 Harshad Mehta stock market scam. This scam was the watershed moment for shattering the confidence of retail investors and Indian families overnight. The stock market crashed over 40% in a matter of months, wiping out many retail investors' life savings and shattering the trust among the middle class. In the aftermath, countless ordinary families swore off stocks forever. Investor confidence was severely shaken. Small investors came away with general distrust of stock market that took years to even partially recover. Now layer on the top of that economic instability of late 80s and 90s. India faced financial crisis in 1991, high inflation in some years, and economy in transition. Jobs were scarce and precious. There was no startup boom or gig economy. On the other hand, financial literacy was almost very low. Even today, only about 27% of Indian adults are deemed financially literate. With limited knowledge and no one to guide them, our parents naturally stuck to what they understood: government-backed instruments, fixed deposits, gold in the locker, or plot of land. These were tangible, trusted, and had served their families well past. Stocks, on the other hand, felt like black box, mysterious, too easily manipulated by big investors. Thus, a fear was integrated. The stock market wasn't for people like us. Let's talk about the middle class mindset that emerged from those roots. At its core, it's deep desire for security. For many Indian parents, the formula for good life was very simple: study hard, get a good job, save money, buy a house, and most importantly, don't do anything reckless. Job means security. And if you have grown up in a typical middle class household, you might recognize some of these traits, starting with safe player pride. The uncle who kept all his money in FDs and never touched stocks is praised like sensible, while on the other hand, your cousin who doubled down his shares is warned to be careful or you'll lose it all. Second, loss means failure. There's a common perception that if you lose money in market, it's more of like personal failure rather than learning experience. Our parents didn't grow up watching Silicon Valley shows, meaning they don't understand fail fast, learn faster mantra. They tend to say, I hold you, rather than what did you learn from it when investments go south. Then it's scarcity mindset. Traditional families operated with thin safety nets. One salary, many dependents, maybe some debt, and no lavish inheritance. They often prefer to have $100 safely locked away in the bank account rather than take risk and make 10 more. In fact, a recent report noted that middle class families kept about 70% of their wealth in cash, bank, and deposits. Then, savers are greater than investors. Saver is a compliment in many Indian circles. There aren't many dinner table stories of
My stock picks really paid off this year.
but plenty about
You could get double-digit interest on fixed deposits.
or I bought.
Gold was just 3,000 rupees per 10 grams back then. It seems unbelievable now.
Financial advice in the 90s and 2000s largely came from elderly people who had same mindset. So the cycle continued. Play it safe, avoid stock market, focus on stable income. It's very important to understand this in context because it explains why your perfectly rational suggestion of investing in index fund might raise your parents' blood pressure. Only about 8% of Indian families currently invest in equity markets compared to 40% in the US, showing how uncommon equity investing has been in the middle class or in India itself. Now enter the era of Zerodha, roughly around 2010s and beyond, where investing in stock market started becoming as easy as ordering food online. Companies like Zerodha, Grow, and many others recognized this. These platforms dramatically lowered the barriers to entry for average Indians. Parallel to this, the rise of YouTube finance creators and other online platforms transformed financial literacy. Complex concepts like diversification or compound interest were being explained with Bollywood and cricket references, making them very relatable and entertaining as well. This digital way means young people no longer depend solely on family advices for financial knowledge. They have Google and YouTube University for that. The result, the perception of investing among youth has shifted from gambling to essential life skill. Many in Gen Z and millennials see investing as a normal extension of managing money, not some exotic casino game. Systematic investment plans, SIPs, in mutual funds have especially gained trust. Last year report shows that SIP inflow reached all-time high as 25,000 crore plus. Technology plus transparency is making difference. When you can open an app and see exactly where your money is invested, track it 24/7 and pull out whenever you want, it gives sense of control and trust that earlier generations never had. This brings us to the big mindset gap between young investors versus their parents. It's almost like we see two different worlds when it comes to stock market investing. Market dip see as the opportunity to buy stocks, whereas parents, they say that they told you it was gambling. Learn via YouTube and data. Learn via experience and fear. Survey shows that fear of losses and lack of trust are still big determinants across India. So how do we break this cycle out of fear and make parents believe investing again? Or at least not totally against it? It won't happen overnight. But here are some things which we can try. First, start small. Open a SIP of 1,000 together. It feels like R&D, not like risk. Speak their language. For example, 5,000 per month for 10 years at 12% equals to 11 lakh. Compare it with FDs. Let math kill the emotion. Third, show, don't tell. Sit with them with the app. Show them graphs monthly and normalize up and down. Use analogies that they get. Diversification is not like putting all rice in one sack. Celebrate wins. When that SIP grows up, buy them at dinner and associate profit with trust, not fear. Stay calm during losses. When the graph dips, tell them the gap between generation save and generation invest can be very huge. And it starts with understanding and ends with mutual trust. Let's break this silence around investing and move towards an India where knowledge replaces fear and growth replaces stagnation. So tell me in the comments below, what's the one money advice your parents gave you and you do still follow it? And don't forget to subscribe for more content like this. After all, the wealth of nation is built on the wealth of its household, and it's time for every household to become an active participant in India's growth. Thanks for watching. See you in the next one.